Talk about financing a business aircraft in this particular market. So I'm going to let each of them introduce themselves, starting with Keith.
Hey, my name's Keith Hayes. I've been in the space for, I'm with PNC Aviation Finance.
32 years, Keith? 34.
And anyway, we a committed team of 40 that all we do is corporate aircraft day in and day out. A diverse product suite of financial solutions, starting with our asset-based product that most of you are familiar with, along with the typical corporate underwritten credits, operating leases and tax leases, and finance everything from King Airs to global aircraft.
Don?
I'm still looking at your picture with your head tilted to the side. I'm trying to figure that out a little bit.
All right, keep going. Come on. Soon, if I hear anything about the Steelers or the Penguins,
No,
we're
we won't go
stopping.
there.
Yeah, go.
I'm Don Synborski. I manage the business aviation group of Citizens Bank. Our group is a true vertical with dedicated credit, legal, asset management, paralegals, and we have 2 forward-facing marketing people and a support staff of 15 to support the business through all the various areas. I've been with Citizens for 10 years. I've been in asset finance since the 80s. Let's just leave it at that. And I enjoy it very much. We have a very good team. I think for us, you know, although we compete with each other, our primary competitor today is cash. It's always been a big competitor, but more so than ever before, that's who we see as our primary competitor today. The bank itself went public in 2015. We were spun off from RBS, and it didn't change a thing in terms of how we approach the market. The risk policy, tax appetite, everything was stateside. For approvals, we did everything within the US. So it was business as usual, other than we are now a public company.
Thanks. Shelley?
Hi, I'm Shelley Svoren. I'm with First Republic Bank. We're based out of San Francisco, but we have offices throughout the entire US. We're a $95 billion asset bank. We are a vertical. We finance aviation and marine transactions, and we've been in that space since 2006, approaching over $900 million in commitments that we've closed. We have not lost a single dime since, or had a single repossession yet. I credit that a lot to our underwriting and our core values. We're led by Jim Simpson, who will be speaking on a panel tomorrow and who has spoken here many times before. While we've only been around in the aviation space as First Republic Bank, we are a seasoned group of 4 professionals. Jim, as some of you know, was at Bank of America for over 25 years before he started the group. And I started in finance, actually banking, in over 26 years ago as a FDIC bank examiner during the savings and loan crisis. And I look forward to being on the panel and discussing different topics with my esteemed colleagues.
Thank you. Joe?
Hi, my name is Joe DeLallo. I'm with BMO Harris Bank. I live in Cleveland and support the...
On purpose?
Pardon me? What did he say? I support the U.S. market. We also support Canada as well. BMO Harris is the U.S. subsidiary of Bank of Montreal, about a $600-ish billion banking behemoth north of the border, and we've got a large presence in the U.S. as well. I help manage our aircraft finance group. Been at BMO for 6 years. I've been in equipment finance and leasing for almost 29, and exclusively aircraft for about 15.
Thank you. Greg?
Yes, my name's Greg Holst. I head up the aircraft lending group at First Source Bank. We finance turboprops, jets, and turbine helicopters. We serve throughout the U.S., Canada, Mexico, and Brazil.
Thanks very much. All right, so our first question, our slides are really questions that somebody on the panel will start the conversation about, but we want all of you to think about what you see up on the slide and have your own points of view and share them. So first slide, we're going to start with Greg.
Yes, I think anyone facilitating an aircraft purchase may benefit from bringing a dedicated aircraft lending professional into the transaction. Reasons being, first of all, they have a unique understanding of the equipment and its value as a business tool. Second, they're usually well-versed in aircraft structures, whether it be finance or lease, that are sound and keep your customer right side up in the transaction through the economic ups and downs. They're also very familiar with the registry issues and considerations, including the international registry. All these things, and that makes me think of an incident. I remember a few years back we had a customer who had a purchase rolling toward closing, and they had worked with their attorneys in their local state to develop an ownership structure, which was a partnership of corporations. And of course, as we get down to the 11th hour of the closing, they come to find out that doesn't work well at the FAA. So again, I think involvement of a lender that's savvy on these issues, can help. All this, facilitates a smooth and efficient closing process when that time comes, which is what everybody wants, including the buyer. I think some of the other benefits, post-closing, aircraft lenders are very adept at facilitating things that come up through the course of a loan, like an overhaul, modifications, upgrades, refurbs. These are things that they're comfortable with and familiar with accommodating. There's also cases where those are involved in purchases of new aircraft from OEMs, where there's progress payments required, sometimes over more than a year and sometimes in the millions of dollars. Many aircraft lenders are able and willing to accommodate financing of those progress payments so it doesn't impact the cash flow and cash requirements of their operating business.
Greg, let me take a break and ask you a question, right? So the point is very well taken, right? It's a specialized asset, specialized marketplace, and specialized product. So a specialized lender, right, can add value to the process. They make for good choices. On the other hand, bankers don't give tax advice, right? They don't give accounting advice. They don't give operational regulatory advice. So that's one of those lines that has to be carefully navigated, right? The separation between being, aware of issues as opposed to having the customer rely on their own resources.
Correct. I think, when I touch on that issue, like with the registration, we usually make it clear that we're not there to give, we're not qualified really to give accounting or legal advice, but we try to point people in that direction to review or take another look at that. We don't get involved in the, determining what people want versus what they may need. If they're qualified to buy the aircraft, we're there to support that process with whoever we're working with. Perfect.
All right, let's go to Keith next for managing time expectations. And Keith, don't take more than 4 minutes, okay?
Thank you, sir. This is a unique situation that we're seeing more and more within the marketplace. We hear of clients out in the space for 1, 2, 3 months prior to ever coming to us, and they're looking for an airplane. They're working with a broker, they're working with an OEM, they're working with a tax attorney, a consultant, and so they spend 1, 2, 3 months finding a plane, and then they spend 2 or 3 weeks working on a purchase agreement or an LOI, and then they put the plane into pre-buy, and they have a week or two, and it's got to close, and then they pick up the phone and call us. And what I would share with everyone here today is it's all about a pleasant client experience. I know when you're trying to help your client find a plane, when you're helping the client on the documentation, the taxes, it's all about a pleasant experience, and it's not going to be a pleasant experience on the banking side, on the financing side, if they only give us a couple weeks to get it done. On top of that, we have clients that come to us, we got 2 weeks left, either that or their broker comes to us and they say, okay, my client wants the longest term, the best rate with the biggest balloon, and trust me, he's an A-rated credit. I mean, how often do we hear that? And the bottom line is, it doesn't matter, anybody on this panel today, we're all regulated concerns, and we will all have to go through the same due diligence process when we go through the underwriting. Now, at PNC, we do have an asset-based loan that is somewhat unique in as much as it is typically non-disclosure and limited or non-recourse. Those deals can go fairly quickly.
Explain what you mean by asset-based and why there's that particular implication.
Under our asset-based program, the client, if there's a directive on what types of planes will go into the program. It's fairly broad scope of what planes can fall into it. The clients put anywhere from 20% to up to 50% if they want, down payment, and based on that down payment, they have limited to no recourse, and they have no financial disclosure. So it's a very unique product in the marketplace. With that said, we still go through a very in-depth know your customer. We have to know who we're doing business with. We have to know where the money's coming from. But we can turn those deals much quicker. But on the corporate underwritten deals, whether it's audited financial statements, tax returns, with K-1s, we're all going to need them. And so when the clients come to us, we want to get as aggressive as possible with the terms and conditions. So if the clients would just come up front with the information, that'll allow us to go back to them with as aggressive as pricing as possible. The other concern what we always have is when the clients come to us with the one-page personal financial statement that says, trust me, I'm A-rated, and they say, okay, you're not going to get anything else before you quote, then we have the potential of letting that client, the broker, the OEM down, because we propose, and then we get the information in, and we find out all the liquidities in a trust that we can't get our hands on, as an example. So now we cannot live with the proposal we issued. And so what's it look like? It looks like the banker bait and switched.
Let me ask a question. Apologize for interrupting. So, experience among the panelists. Raise your hand if it's typically the case that the deal that the customer first explains to you is actually the deal you close. All right, raise your hand if that's what's typical. Right. There's deal evolution. Right? From the time they come to you, they have in mind what they want because they've gotten advice from God knows who, and sometimes smart and good people, and sometimes not. And then ultimately, the deal you close is the deal that you can approve, the deal that can get done. And so, the timing thing that Keith is talking about, you need that time to pass. You need time for the deal to evolve and become what it's ultimately going to be.
And the other pressure point in this is the LOI. We've talked about the fact that there's not much inventory in the market. So a customer signs an LOI, he's talking to the lender, and if that plane gets sold out from underneath him, we're back to square one. That's been happening a lot in the second half of this year.
Okay, terrific. Okay, next, risk mitigants. So Keith alluded to the process, the risk mitigation process, which is, underwriting, due diligence, all the appropriate processes banks go through. Shelley's going to expand on that.
One of the biggest changes that's occurred over the past few years is the know your customer due diligence that's required by financial institutions. It's mandated by the federal government. There are no ifs, ands, or buts about it. You must comply with this. And so what we try and do up front is collect the data necessary to conduct this, because essentially how we treat it, we can't move a request forward until we've completed our KYC due diligence. That's critical to us. You need to understand the why, the how, and how everything is completely structured. If you don't have that, then the deal isn't going to go forward. And if you don't comply with this, as a regulated institution, you're potentially facing civil money penalties. So this is very real, and I would ask every single one of the brokers out here, make sure your customers are aware of this. Make sure that they understand if they are seeking financing to be as transparent as possible about the structure of their organization.
So that's one of the gating issues. What about the risks that you evaluate when you price the deal or decide whether or not you're going to do the deal?
Well, a lot of times when we're looking at a transaction, we're looking at the relationship holistically. We're looking at who the client is, what they're about, what their sources of cash flow are, what their liquidity is. And liquidity can take on various types of asset categories. We've seen clients who have massive art portfolios, and they've been able to leverage those and obtain lines of credit. So do they have access to liquidity that can support repayment of the transaction? And then broadly, too, as far as pricing a deal, we take a look at the structure, the loan to value. I think that's probably what all of my colleagues would do as well. The tenor of the transaction, also the quality of the aircraft collateral that we're taking, and how the client's going to use it. That becomes a big part of how we structure our transactions.
So among the group, keying on what Shelley said, who among you is in the business of financing aircraft or alternatively providing financing to customers, your own customers who might want an aircraft financing, right? So, right, are you industry focused or are you customer focused?
We're both.
Absolutely both.
Definitely both.
Okay,
Definitely both.
right. Yes, but it's not like the old days, right? Isn't it different than the old days where it used to be much more asset focused among the banks?
I would agree with that,
Right.
without a doubt. I was with GE for a lot of years, and in the fourth quarter, it was nothing but crunch, 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 and you knew the plane, you knew the structure, and you didn't spend a lot of time with the clients. It didn't work out so well.
Right. Say that one more time.
No.
It didn't work out so well.
It didn't work out so well.
Yeah,
no.
right.
So there's a lot more on the know your customer side. One other piece I'd like to bring in, we've talked about the buying piece. I'd also share with everyone, because we've seen this quite a bit on the selling, when you do your lien searches and you see who currently owns the airplane or finances the airplane, get with that finance source very early on for your buyer as well. If the finance source is being paid off by another bank, it's typically a non-issue. We know where the money's coming from. But as Don mentioned, one of our biggest competitors is cash. So if we're being paid off, as PNC's being paid off from cash on a plane that's out of our portfolio, and we get a call 2 days before closing, and now we have to start doing the know your customer on where that cash is coming from. We just had a situation where the basis of the company that was paying us off was a car dealership. Well, they also happen to be in an area that is starting to grow certain five-leaved things. And so that's part of the business as well. And so we have issues taking money from anything coming out of the marijuana industry. And that caused a delay in that closing. If we'd have known about it a week before, we could have found out and worked through it. So
Thanks.
it goes on both sides.
All right, so let's talk about the economic cost of lease products. So how many of you offer leases to your customers who want lease acquisition financing? Okay. Don's going to talk about how a financing provider decides to offer that product, what that financing provider considers when offering that product, and what customers are looking for.
Yeah, so I think that, I'm just going to compare this to where we were pre-tax law change. If you think about where we were in a reduced bonus environment. I think we were down to 40% in 2017, but we had a much higher effective tax rate of 35%. Post-tax reform, 21% tax rate. Full bonus for the foreseeable future. Full bonus will stay in place through 2022 and then start to come off 20% per year thereafter. And I think that it has a pretty good chance of staying in place unless the deficit becomes so large that Congress has to act. Even though we think of it in terms of large today, what I mean by that is, the proponents of the tax bill asserted that eventually it would be a revenue provider and reduce the deficit. If that fails to be the case, with a singing economy, we can expect to see changes. But I think right now we're in a pretty good spot. We gave up like-kind exchanges, so we lost that, but we picked up, which I think was a bigger pickup, full bonus on used assets. So when you look at the two economically, on a shorter term lease deal, all things being equal, same residuals, same aircraft, everything being equal, on a 5 to 7 year lease term, your economics are about the same. It's hard to say which is the bigger driver. Is bonus a bigger driver than tax rate? I would argue it is, because a 14-point reduction in tax rate to 35 to 21 is a fairly big negative. Where it comes into play is on the 10-year lease. On a 10-year lease, your economics are about 10% to 15% higher than they would have been under the old tax law. So there's where your increased cost is. But that's only part of the story. The real part of the story that has nothing to do with the tax law change is the value declinations. After the collateral damage was done literally, we got linked at the hip with risk. And if you think about it, Shelley talked about risk. Risk policy is in place to mitigate big, uncertain events, to have controls in place to mitigate those. The value impairment we suffered, despite our best efforts, was an event we didn't have risk policy for. So risk and aircraft are linked at the hip going forward. We meet with them semi-annually. We talk about the state of the market, where values are going, strategies on planes that may be impaired. Everybody goes through this. So I think that's changed our view forever. So the bigger impact on lease pricing, cash rents for leasing, is where residuals are willing to be placed today by lessors. You could argue where they are, but they're down 25 to 35% from where they were. That's the bigger driver of the increased cost of leasing, much more so than the tax bill itself. I think the overall pickup on the tax bill outweighs that to some degree, but I think the other issue for a lessee is how they look at the two. And the other thing I'll just mention briefly is almost everything's on book. There's very little that's going to be off balance sheet going forward. You go through this finance lease classification that's different today than it was under FASB 13, but the end result is if your lease has a fixed option, whether it be an EBO or a fixed purchase option, it really becomes a decision that's in the hands of the audit partner at the firm as to whether or not it's going to be on book or off book. You can do all the analysis you want. We've run into a couple of situations where one of the big four firms, their audit partner takes the view that everything is on book. So it's likely that it's going to be on book in some capacity.
Do you get much demand for operating leases and where the auditors make you go through all of the gyrations?
Yeah, I think we see more of that, but I also think one of the things that changed is our mentality as a group has changed with the focus on value and our desire to always manage it. We used to put it on the shelf, forget about it, whether that was right or wrong. Values were increasing in our favor, we didn't worry about it. Today we have to have the thought process of an op lessor. We have to think about managing our portfolio, managing our concentrations, managing our term of various financings, and look at what's coming off at any given point in time and potentially how that would impact our remarketing efforts. So I think for the good, that's been a change that's been a positive.
Okay.
One of the things I'd like to add to that is what I typically see is financing doesn't drive the behavior of our clients and the ownership behavior. In our $2.5 billion portfolio, it turns somewhere between years 3.5 and 5. Whether it's mission change, whether it's a new CEO, whatever it might be, the ownership of planes typically turn from 3.5 to 5 years.
Has that stayed steady, since the recession?
It has.
Okay.
What happened, you went through the one period of time where people were so far underwater that they went full term because it was just too expensive to get out.
Right.
But now the behavior has gone back to more to the norm because the financing structures are more properly put in place. But the long-term leases that Don's referencing, generally speaking, they're structured in such a way they're long-term for cash flow purposes, historically for off-balance sheet purposes, changing now.
Right.
But they're, generally speaking, we're set up with EBOs at the point in time when the client's going to get out. And whether it's an operating lease or a synthetic lease, one of the other huge benefits is as some of the states are getting tougher and tougher with the laws as it relates to sales and use tax, And some of the structures that some of the state, but you could put that you structure your financing and historically your ownership in, some of the states are saying, no, you're going to pay sales tax up front if you do that. In most states, if on a synthetic lease or an operating lease, you pay monthly use tax. You do not pay sales tax up front. So if you own a plane for 5 years, and at 5 years your balloon is, let's call it 60%, you sell the plane, out of town? You sell the plane and you save the sales tax. I got to shut up.
All right. He'll stay after. He'll answer all your questions. Nobody will be here. He'll be talking. It'll be great. Don't worry.
And I do want to jump in too. Even though we are a traditional lender, we do full recourse deals. We still look at the portfolio quality. We look at the mixture of it. We look at the diversity of the aircraft collateral. We look at where our clients reside. We also take a look at what they do for a living, where the sources of cash flow come from. And it's just good portfolio management, and I'm sure everybody else does that as well.
Thank you. So we had a question for the audience, and we're looking at the responses, right? So now that you're ready to use the lender, how do you decide who to use? You know, it looks like the polling shows it's a responsiveness and quality of execution is the paramount determinant. Relationship second, rate economics third. Is that your experience also, panel? Do you agree with what you see there?
Today it is, yeah.
I think it is to a large degree, but I also think that rate is a redeeming quality in an airplane financing or any financing. So I think, you know, from a pure client standpoint, they've got advisors, and most of the folks we're working with are on their, you know, second or third or 10th airplane. They've got a team of people that they just expect to execute and do well. So I mean, to me that's kind of an inherent expectation that you're expected to deliver. But I also think without a competitive offering, you're not going to be too active in the marketplace.
Right.
I would add that the quality of execution, your responsiveness is paramount, as the survey indicates, and that ultimately, you know, wins over everything else, because for both the seller and the buyer, having a comfortable, clean closing that they're confident is going to happen is what really matters in the end, and that's what I think leads to relationships. I kind of think 2 and 3 go hand in glove. If you have a consistency in handling your closings and you're responsive and things go smoothly, you're going to build a deep relationship with that client, and that's ultimately going to surpass things like rate and other economic considerations.
Okay, big question for the panel. Are we overbanked? And, you know, not every financing provider is a bank, but you get the question, right? Do we have too many providers of financing in this marketplace, given how the marketplace is situated, the number of customers who want to finance aircraft? Anybody can start.
I'll jump in. I think if you bifurcate the space, the answer is no, but yes. If you look at the team of true aviation finance specialists, whether it's us here, whether it's B of A, whether it's Global Jet Capital, I don't think there's too many in that space. What we see from time to time, and now it seems to be happening more and more often, is a regional bank or almost a community bank that jumps in, and they don't have the same level of expertise. They don't have the memories that we have. And so they're coming in with 100% advance, 95% advance, and a 20-year amort on a 15-year-old airplane.
Okay. What does everybody else think?
I don't think we're overbanked. I think where you really see a need for capital is on the credit quality deals that are below what a bank can do. And what I mean by that, banks are very restricted today on where they can lend in terms of how much leverage a company has, you know, what its total revenue size is, the quality of its financial statements. There's a lot of regulatory issues we have to jump around to do those deals that our eyes tell us are good deals. And when we can't do them, what I see in the market is a big bump in rate when you move into that second tier. So I don't believe we're overbanked. If anything, I would argue that what we need are more commercial finance type Stonebriars of the world. We need more in that space.
I'm sure the guys from Stonebriar here are very happy to hear you say that. I do find that it's niche-y, right? That
Yeah.
I
right
don't even
folks
know
are
if I
finding their
call it a
niche.
niche.
So.
I think the bank the bank risk bucket is being squeezed, right from a regulatory perspective.
Well, part of it is based on the experience we've all had over the last 10 years of a pretty interesting market. And I think that this week was a good example for me. I mean, I think there's maybe we're a little overbanked in certain segments in that plain vanilla, 10 to $40 million transaction size. But there's not everybody that finances aircraft will do a Global or an 8X or a G650, and not everyone will do operating leases. And not everybody will do 714 transactions that Adam does in AOPA, through October, for a space that is, basically not covered by most of the banks in the marketplace. So I think there's a need for the number of folks that we have. It's a huge industry, and even though most people pay cash, very few of us are trying to be everything to everyone. We're trying to stay in our lanes and do what we do well.
Well, BMO keeps acquiring, but Greg, did you want to add anything?
I would just say that I think ultimately, bankers sometimes think there's too many banks, but for the customer, I think the more banks in this business brings them more choices and more opportunities and ultimately better service through competition. So it's a good thing for the industry.
The American way. So, Mr. D?
Yeah, so I've got the last couple slides to try to bring it home and figure out things to talk about that haven't already been discussed. But I think the key takeaways are that as an industry, we're trying to support the industry as a group of lenders, whether it's through operating leases or through debt transactions, et cetera. And not all doctors are created equal. Not every broker is created equal. Not every aircraft or every bank, we'll say, or finance institution.
But some lawyers are better than others, right?
Yeah.
Some,
But
the key word.
I guess my point is the folks on the panel. I mean, we're a small representation of a big industry. There's 3 times as many lenders in the room here, and that scratches the surface of the number that service the marketplace. And I would just propose that you don't have to go outside this room or outside this circle to find the attorneys you need and the brokers you need and the manufacturer relationships and understanding that you need to manage your clients well. And not everybody that lends and tries to finance aircraft, they don't know what NBAA is or what NAFA is or what CJI is. And I think that it's important to, if we're going to add value, we've got to, I think you've got to bring experience and you've got to bring relationships and market knowledge to bear. Otherwise, you can't differentiate yourself from all the other banks. So I think that the people that get the industry and are immersed in the industry are the ones that can manage the expectations of the transactions and the timeline and provide a positive experience.
Joe, do quick hits on the structuring.
Yeah, so the structuring considerations, it's pretty simple, and Shelley touched on it earlier. You've got to understand your client and what their needs and wants are, and then you've got to understand the aircraft that they're getting and whether it's an 18-year-old plane that's 3 derivatives from current, or whether it's a brand new aircraft and any PDP payments. And then once you understand the client needs and the client's credit profile, if you're doing a credit-focused financing, then you back into a solution that makes sense for the lending institution, but also for the client. Because as I think he said, most of the clients call and they say, I really would like 100% financing, I'd like an 80% balloon, and I'd like a 7-year term, and I need a really low rate. And maybe in 2006 or 7, That was something that could be discussed, but not today. So, helping them understand and guide them to what they want and what they need, with the right structure, keeps them out of trouble. I mean, there's the same folks that sometimes ask us for really aggressive terms are the same people that are in trouble because they've got a plane now that's worth $7 million and they've got a $10 million loan balance. So I'm like, why do you want to structure another deal to get yourself upside down again because you're very upset about that?
What do you do if you think they're getting bad advice? Right? If they come to you with some ask that doesn't seem to make sense given your experience with the various accounting, tax, and operational issues?
I think the best thing you can always do is point to the facts. Share the facts. The facts don't lie.
Sounds like a CNN commercial.
When presented in the proper light. I mean, I think as Joe and everyone here has mentioned, we have a wealth of knowledge in this room. So if it's not just coming from me, you can point to a source, such as an aircraft appraiser who you know quite well, data points in the market to show here is what is happening, here's what people believe will happen to this, and this is why we need to structure in this particular way. And if they need information, make sure that they can contact those individuals. I found that that works well, but then again, you always get someone who has, as I've heard some people refer to it, the cream puff, the most perfect version of that aircraft on the market, and it's not going down in value. It's very hard to talk a client out of that if they believe that to be true. And so you have to structure around that to make sure and keep them informed about the value of that aircraft or what is going on in that particular marketplace.
But
And
you have to be careful,
you have to
right?
be careful.
Because they come with their own resources, and whoever those resources are, they're going to be there for the mostly for the remainder of the deal. And so you have to balance, what your immediate reaction is, which is like, no, you're an idiot, with, okay, how do I get this to closing by getting them to come around to where you are? It's delicate. It can be among the things that take the most time, getting them to where they need to get to.
And that's where relationship building, trust does become important, both ways.
Okay.
I think it's also just open and consistent communication. And we get 65% of our leads from everyone in this room. And when you come to us with an opportunity and then the client wants to finance 90% and we have an issue with the value, it's very difficult for us to come back and say, we've got an issue with the value when you brought us in on the plane. So it's just constant upfront communication between us and then also with the client.
Joe, anything else to cover on the structural issues that we haven't covered?
I don't think so. I think that the term, every deal is a snowflake, because each one's, I guess that's used in a political sense. I didn't mean it that way at all. But each transaction, each client, each aircraft is very different. And if you've got a lender that says, our menu includes a 5-year, 15-year amortization at, LIBOR plus 200, I would propose that they're not a real experienced long-term provider in the market, because you shouldn't approach transactions that way. Anytime you start generalizing anything in business aviation, I think you tend to make mistakes. So the point of creating a structure is, the structures we offer for a billionaire is different than the structure that we offer for a $50 million net worth real estate developer that's a really strong client of the bank, and we've got to figure out a way to support their 18-year-old aircraft. An aircraft that's 18 years old is structured different than one that's 3 or 4 years old. The amortization and the advance rate and the equity that you want or that you require as a bank up front is different. And when you structure that loan to value or that curve, you say, look, it's a challenge for all of us in the room to know what the market's going to be like next year. Everyone has different opinions. As banks, we have to try to. Our crystal ball goes out 5, 7, and 10 years usually for forecasting what we think the planes are going to be worth, because that's how we set our amortization. So the aggressiveness of the structure is also a function of the aircraft type and its how it's retained its value in the past, et cetera, and also the credit strength of the underlying borrower, because for a less than investment grade credit, you want to make sure you've got adequate collateral coverage if they stop paying you. Whereas if it's a really strong credit and the credit risk and the risk of default is very low, then you can rationalize, I rationalize, taking a more assertive structure where you don't have to have that complete collateral coverage from day one through the end of the loan or the lease, because you're willing to take an undersecured risk on that transaction.
Thanks. Time for questions.
We've got a bunch on the board here too, Ed. There's 3, 4.
We'll let the
Four to 10
live
others.
version go, but
Okay.
thank you.
I'd like to ask the panelists on ADSB, are you, in looking at your portfolios to see which, if your customers are in compliance, if they're not, are those events of default, and are you looking at possible impairments, or is it a one-time episode?
I would say, while ADSB is obviously a very current item and it's going to get talked about a lot more over the next 12 months, it's kind of old news in our group. I mean, every client either is compliant or has a plan, a stated plan that they've provided to us, and we keep in steady communication with them to make sure that they become compliant so that there's not an issue. And it's really helping them stay in front of it and obviously protecting our portfolio.
Our experience is the same. We were very proactive to reach out to clients, but they've either complied or they have a plan to do so before the deadline.
We started speaking with our clients 2 years ago about ADSB, and whenever a client is in the process of purchasing an aircraft, it's a discussion right up front.
We've been monitoring that. I think we've seen a high degree of compliance with ADSB upgrades, but if there were a client that wasn't able to get it done in time for the deadline or was having trouble with that expenditure, perhaps, somebody we'd want to work with to help get ahead of that as much as possible, and if necessary, get through the backside of it.
Okay. No more questions?
No, that's great. I think we'll stop there. Thank